Investors are again on edge about whether the trade dispute between the U.S. and China will curtail global economic growth. The tariffs already in place have pressured the overseas sales of some U.S. companies, such as car makers and other industrial manufacturers, and raised costs for others. And even with a 90-day truce between the two countries, investors worry President Trump could make good on his threat to enact more levies on imports from China, extending the spat further into next year. If the tariffs escalate, analysts expect dozens of companies in the U.S. technology manufacturers are among the most affected, but companies in other sectors, such as the consumer discretionary and healthcare industries, are also heavily exposed to the country and could run into problems if trade pressures continue to build. Waning enthusiasm for the trade truce has pressured the shares of everything from tech companies to industrial giants this week. Companies that have a high level of asset exposure to China, including iPhone maker Apple Inc. and casino operator Wynn Resorts Limited, are also at risk as ongoing trade tensions could lead many to make costly alterations to their supply chains, according to Goldman Sachs Global Investment Research. Whirlpool Corp, for example, said earlier this year tariffs have pushed commodity costs higher, forcing it to raise prices. Sales have suffered since then, the company said. Ongoing trade tensions have already eaten into some analysts' growth forecasts for 2019. Any escalation in trade tensions could crimp global growth further, analysts said. U.S. stock markets have gyrated this week with seemingly positive news on trade followed by President Trump tweeting he is still a tariff man. U.S.-China tensions, plus worries about economic growth in the tech sector, spell more volatility ahead for investors. Public and private U.S. companies have been getting a bigger share of their sales from overseas in recent years. Tariffs have showed some signs of curtailing that activity, with companies like FedEx Corp. and AutoZone Inc. warning on their most recent quarterly earnings calls that the levies are already hurting their businesses. Although companies in the U.S. compared with other sectors, technology firms are most exposed to China and other countries in the region, making the sector's stalwarts, like Apple and chip makers such as Intel Corp. particularly vulnerable if the U.S. expands its tariffs on Chinese imports. Even with the sweeping corporate tax cut that boosted profits, the trade tariffs have factored into the volatility, with investors worrying that the levies will accelerate a slowdown in economic growth at a time when the Federal Reserve is raising interest rates. In China, though, the trade spat has been more punishing as the country's Shanghai Composite has sunk into bear market territory and is on pace for its worst year since 2008. Write to Michael Wierstorn at WSJ.com.